On February 1st, 2012, ABC purchased a machinery for $10,600. The estimated useful residual life is $400 and expected useful life of 4 years. The company incurred a $2,000 overhaul to the machine and $1,000 installation cost. Cost of cleaning and disposing of packaged materials after installation amounted to $500. On July 1st, 2014, the company sold the machine for $1,700 cash. So the first part asks us to record the purchase of the machinery. So here we're given a couple of items that was included in the purchase. So first of all, the purchase of the machine was $10,600. Now, we're going to analyze the other expenditures. And the key to the concept here is that we capitalize to the cost of the equipment if if these costs incurred was necessary to get the equipment into its intended use. So in this case, the $2,000 overhaul to the machine is going to be included in the cost of the machine because it is part and parcel. It's important to get the asset to its useful state. The installation cost is also necessary to get the asset to its useful condition. So we obviously need to install it before we can use it. So clearly you can assess the argument that those two costs should be included in the cost of the equipment. The cost of the cleaning and disposing of the packaging materials, when you unpack the equipment, all of that cleaning and packaging material and all of those disposal amount to $500. There's arguments to be made whether that cost should be expensed or should be capitalized to the equipment. In this case, that cost should be expensed because it wasn't necessary to get the asset to intended use. So that's normally an expense item. So let's solve the problem. So first of all, in part A, it's asking us to calculate the cost, record the cost of the equipment. So the cost is the purchase price. That is $10,600. We're going to add the installation of $1,000 and the overhaul of $2,000. So altogether is $13,600. The cleaning fees will be expensed, right? So the entry will be debit machinery, which is an asset, debit cleaning fees, which is an expense, an increase to the expense of $500, and we're going to credit cash. So that answers the first part of the question. Now, second part of the question says, using straight line, what is the amortization expense for 2013 and 2014? Now, this asset was purchased on February 1st. Okay, so data purchased was February 1st, 2012. We have to be mindful of that day because we need to prorate the first year of amortization. So first, let's calculate the yearly amortization expense. They're going to use straight line. So we take the cost of the equipment, $13,600. subtract the residual value of 400 divided by number of useful life, which is 4 years, to give us 3,300 per year. So for 2012 amortization expense, it would be 3,300 times 11 over 12. Because that would be the prorated year, because we bought it on February 1st. So that is our first year of amortization, which is 3,025. For 2013, the amortization expense will be the 3,300. So our journal entry is going to be, so it's going to be debit amortization expense, credit accumulative amortization, for 2012 will be 3,025, and for 2013 will be 3,300. Okay? Now, let's look at Part C. Part C says that we disposed of the asset on July 1st, 2014. 2014. So first of all, what we have to do is we have to determine the net book value at July 1st, 2014. So we know that from January 1st to June 30th, 2014, we need to record the amortization expense. Okay, because first, before the date of disposal, we have to update the net book value. So we have to amortize the asset. So first, we're going to debit the amortization expense. Now we know that the yearly amortization is 3,300. How many months? It's 6 over 12 months. Gives us 1,650. That's the first step. Okay. Second step is calculate the net book value at 7/1/14, which is the date of sale. Okay, so how do we do that? Well, we have cost. What was the cost amount? The cost amount is 13,600. Accumulated amortization. So for 2012, we amortized the asset 3,025. 2013, it was 3,300. And 2014, June 30th, was 1,650. So the accumulative amortization is 79.75. So net book value is the difference, which is 5,625. Then third step is we're going to calculate the gain or loss. How do we do that? We need to calculate the proceeds of disposition, and in the question we're told it was $1,700. We're going to subtract net book value at 7,114, which is this number here, giving us a loss on sale of $39.25. Now we're asked to do the journal entry. So the journal entry is going to be, first we're going to debit cash. So this is the journal entry. We're going to debit cash. And this journal entry is on July 1st, 2014. We got $1,700 cash. We're going to take the cost and the related accumulative amortization, okay, off the books, so to speak. So we're going to debit accumulated amortization of $79.75, okay, which is this number here. And we're going to credit the cost of the machinery, $13,600, because that asset no longer, right, it was sold. Then we're going to debit the loss on sale, which is the calculated amount, $39.25. Okay, and that's our journal entry on the date of sale. So as a recap, when we sell an asset, the disposal, we need to be mindful of the date of sale. The date of sale was June 30th or July 1st, 2014. So the first step is we need to record the amortization expense for the period of use prior to the sale. In our case, it would have been January to June 30th. So this is always an important step because this is a step that students often miss. So first you need to record the amortization, and of course it's partial year. It's $3,300 was the yearly amortization times 6/12. That gives us the amortization for 6 months, brings us to June 1st, or July 1st. Then step 2 is we need to calculate net book value of the asset disposed at the date of sale. And how do we do that? Well, we look at our costs, less all of our cumulative amortization, including the one that we did in 2014. That gives us a net book value of $56.25. We compare that against the proceeds of disposition to calculate the gain or loss. In our case, we have lost by disposing of the asset. We lost on the sale of that asset for $3,925. Then our journal entry reflecting the sale of the asset. So first we're going to debit cash for $1,700, the amount of money that we received. We have to take the cost and the cumulative off the books because that asset's no longer in sample companies. Okay, so we need to debit the cumulative amortization and credit the cost of the machinery. And of course, we have to record the loss on sale. And if you add that, the debits and credits should balance. Thank you.